Hello and welcome. Wanted to give a brief update and a brief kind of overview of cash versus accrual basis. And that's really an important principle that we're going to be looking at this week, because really when you get into why we do adjusting entries and those types of things, a lot of it kind of comes back to the importance of revenue recognition and expense revenue recognition. And I want to kind of just discuss that today in a brief video. So let's move over to some of your slides. And first and foremost, take a look at this particular slide. It talks about the accounting period. It's a good overview. And again, when you hear the terms annually, semi-annually, monthly, quarterly, it just gives a breakdown of what we're looking at. So annually, of course, being one long period, semi-annually 2 periods, monthly 12, and then quarterly would be 4 periods. So just good pocket information there. But what I really want to get into is a discussion of accrual basis and cash basis. And if you think about when we prepare financial statements for end users, whether that be within an organization or outside of an organization, it's really important for us as we're presenting information to be accurate and to provide a true picture of what's happened. And so if you read the definition here under the accrual basis, revenues are recorded when products or services are delivered and when and records expenses when they are incurred. Cash recognizes the revenue when the cash is actually received and when the expenses are recorded when the cash is paid. So if you think about that, under the accrual basis, if I provide a service for somebody, whatever service that may be, whether I'm in consulting or whatever else, I provide this service, and at that point in time as an organization, either I have provided or I've got an employee that's providing a service, and I'm going to, at that point in time, have to then pay my employee or pay myself the salary expense for providing the service. It's going to be an outflow of expenses. If I look at that particular point in time and I say this person has received a service and they have now incurred a promise to pay me, whether they've paid me physical cash or not, it could be that I have a receivable coming in. But at that point in time, I have then earned a receivable. I've earned revenue as a credit, and then I've got a receivable sitting as a debit. It's an asset. And then perhaps a month later, they may come in, this customer may come in and say, I'm ready to pay off my debt. And at that point in time, they then give me the amount of cash that I owe, or that they owe me rather. And at that point, what's happening is it's an asset to asset exchange. And so, in other words, I've gone from having a revenue item in the previous month and a receivable in the previous month. Now, in the current month, I'm going to then credit the revenue. Credit the receivable, which would zero out the amount that was owed to me, and then I'm going to debit cash. I'm going to convert it to cash, and we'll see that as no further recognition of revenue, but we will see it as a change in asset composition. And let me just show you what I mean by that here. Just very quickly, and I won't take long with this example, but let's say this is January 1st. In this situation, I have a person, I provide, let's say, consulting services. I provide consulting services to a client for $500. And so my debit is going to be to accounts receivable, assuming that they haven't paid cash, for $500. And I'm going to have a credit to revenue for $500. Now, in this situation, I've got an increase in revenue because we know that revenues are increased with a credit. I have an increase in receivables because we know they're increased with a debit. In the following month, let's say February 1st, the person comes in and makes a payment. In that situation, I'm then going to, and they pay me in full with cash. I'm going to debit cash for $500, and then I'm going to credit accounts receivable for $500. And in this situation, basically what's happened is this account receivable is now gone. It's now been zeroed out. And what I had originally hoped to happen as a business owner is now happening. I've got the revenue recognized in the month that it was incurred, and it matches the expense. In other words, the revenue that I generated matches the outflow and payroll that was used in that month. And so I don't have months where I'm overstating my revenue or overstating my expenses. I'm painting a true picture of what's happening. If I had only recognized this at the time in which it was received, and I didn't have this account receivable, I wasn't looking at it that way. I didn't recognize the revenue and cash until, say, February 1st. Well, the reality of it is I would have incurred the expense for that revenue item in the month of January. And yet I'm not recognizing income until the following month. That doesn't make for an accurate picture. And that doesn't help me convey what it is I'm doing in an accurate basis to those that need to use the information. So that's really why it's important that we match revenues and expenses in the month in which they are incurred. Now I'm going to go back to the slide here for just a second. Okay. So again, under this situation, if we're looking at revenue recognition, quite often the simple example I just gave you is really kind of what's happening. We're trying to match the revenues and the associated expenses in the period in which they are incurred. Now, you notice in that example I just gave you, I did not recognize a further receipt of revenue in the month of February. The revenue was already recognized in January. I just, at that point in time, when I had the cash payment to satisfy the receivable, I just traded one asset for another. And that's basically what this is telling us. That's good accounting. And that allows us to present our financials in a way that really presents a true picture of what happened during the month. If I have that lag of collections, for instance, then it doesn't really give me an idea of which months have been, for instance, if I'm looking at a month-to-month analysis, if I'm only looking at when the cash comes in, well, what if the cash all comes in April, and yet I've been incurring expenses along the way in February and March and all that sort of thing. In that situation, I would look artificially bad in those previous months because I didn't have revenue to match the expenses that were incurred. And then in the month of April, I look tremendous because now I've got this influx of revenue because I'm recognizing it when cash comes in. And that's not really truthfully what happened. I had earned that revenue months before. And so that's why we do this. That's some of the kind of underlying framework that you need to be thinking about this week as we begin to kind of get into this 2-week study. And, again, try to think through the process. And given this example that I gave you today, just think through why we do what we do. It's really important at this point in time to be considering why we're doing the transactions we're doing, almost more so than the transactions themselves. If we can think about why we're presenting things the way that we are, then I think the math and everything else is going to make a lot more sense to you. All right. As always, if you have any questions, please reach out, and I look forward to hearing from you soon. Have a great week.